Should you be holding property in your investment portfolio? In just the last month, 3 major property funds have announced that they are either suspending or closing down completely. So is time up for property as an investment? Well, not necessarily. Global property is still huge. It's estimated that the total value of all global property is around $326 trillion. Now, to put that into perspective, that's more than the value of all global equities and fixed interest combined. So property is still the biggest store of wealth. And to understand whether you should be investing in property, we need to look at what sort of returns you can expect from property and the risks involved and how they differ to other investments like global equities. So that's what we're going to explore in this video. I'm Carl Roberts. I'm a regulated financial advisor. Now, for most people, buying a physical property to rent out as an investment is not going to be an option. It's going to cost too much, there's going to be ongoing fees to pay, maintenance fees, and there's a hassle factor with owning physical property. So to keep things simple, if you still want to invest or include property in your overall portfolio, there are things called property funds. Now, a property fund works much the same way as a global equity fund does. There'll be a fund manager. You'll pool your money together with lots of other investors, and the fund will go out and buy physical property. Now, this type of property will include things like hotels, retail units, warehouses, and office blocks. And the idea being that over time, you'll hope these assets will grow in value, but you'll also receive rent from these physical assets. There are 2 types of property fund: an open-ended property fund or a closed-ended property fund. So with an open-ended property fund, sometimes called an OEIC, the fund will own all of the physical property it invests in, and the price of a unit in this fund will reflect the underlying values of all the assets the fund holds. The underlying assets, all the property, will be valued on a periodic basis, so not every day, and this can cause issues, which we'll come to a bit later. A closed-ended fund, also known as a real estate investment trust, or REIT for short, is a bit different. So it still buys all the physical underlying property assets and holds them, but the price of a unit works a bit more like trading a share in a stock. The price of the unit will reflect the demand for the shares. So if a particular REIT is popular, then lots of investors might want to buy shares in that REIT, and that will push the price of the share up. So the value of the share could be way above the actual physical value of the underlying properties. And it can work the other way around as well. If demand is low, the share price can fall significantly below the value of the underlying properties. So that's the difference between an open-ended fund and a closed-ended fund. The open-ended fund, the price of the unit is always going to reflect the underlying value of the assets, whereas the closed-ended fund is going to be based a bit more on supply and demand. So it's not a case of which one is better, or a closed-ended fund or an open-ended fund. It depends on what suits your individual circumstances. What sort of characteristics of each type of fund do you prefer best? So let's explore these next. So if you're going to include any asset in your investment portfolio, you want it to do one of 2 things. Either to generate better long-term returns, or reduce the overall risk of your portfolio. Now, one element of risk is volatility, the movement of prices up and down. How much do they swing every day? Now, with an open-ended property fund like an OEIC, they can appear much less volatile than a closed-ended fund like a REIT. But this can be a bit misleading, which we'll come to in a minute. So the reason open-ended property funds appear less volatile is because they're not valued every day. The underlying assets are not valued every day. They're valued on a periodic basis. So it's a bit like your own home. If you own your own home, if you were to go out on the street every day and ask various people how much they would pay for your house, you'd get wildly different amounts every single day. So it would look like the value of your house fluctuates and looks quite volatile. But of course, people don't normally do this. You might value your home every couple of years, every 5, maybe even 10 years. And every time you value it on that basis, it will look like you've seen consistent growth in the purchase price. So the same principle applies to the open-ended OEIC. Because it's not valued every day, the valuations appear much more consistent. But it's a bit misleading because obviously values do fluctuate underneath. It's just not reflected in the unit price. A closed-ended REIT fund will behave much more like an equity stock because the share price for a REIT fund will reflect the demand for the share. And we can see this in the following graph. This is comparing the Legal and General open-ended property fund versus the iShares REIT. And you can see that the Legal and General fund appears much more consistent and less volatile than the REIT. So if you don't like the wild swings in prices of an investment, then an OEIC or an open-ended property fund could be more suitable for you, even though it's a little bit misleading. But one of the problems with an open-ended property fund or an OEIC is access to your capital, access to your money if you want it. Now this is what we call liquidity. When we talk about liquidity, we mean how easy is it to pull your money back out of an investment? Is there money available? So with an open-ended property fund, because the fund obviously owns the physical assets, if lots of investors all want their money back out at one point, it's going to mean the fund needs to start selling some of those assets. And it's not an easy thing to sell a large commercial property, say a large hotel or a large warehouse. This is going to cost someone a huge amounts of money to buy. So how many buyers are there out there at any one point in time? Not that many. So it's not a quick thing. And it's probably going to mean then they're going to have to sell at a distressed price. So this is why property funds suspend, open-ended property funds suspend, is because they need time to stop withdrawals and they need time then to go and sell some of these assets. And this is what's happened recently with the likes of St James's Place Property Fund, the Canada Life Property Fund, and the M&G Property Fund. So one of the reasons you might want to own property in your investment portfolio is because you want to diversify. You want to own different assets in the hope that as one asset goes down in price, there's another asset that goes up because the economic conditions are more favourable for it. So this is one reason why a lot of people hold property. But if you hold a REIT, a closed-ended fund, then its characteristics are very similar to equities. Over the long term, property hasn't outperformed equities. Global equities have performed much strongly. But global property has followed the same sort of trajectory. So if global equities are down, quite often global property is down with it. So you're not actually getting that much of a diversification in your investment portfolio if you hold REITs and global equities. They act the same way, they have similar levels of volatility, and it just so happens that actually global equities have outperformed property over the long run. And in recent years, global properties had a tough time up against global equities. If we think back to COVID, it changed the way people work. Lots more people are now working from home, so the big office buildings are not valued as much as they once were. They're not getting the same amount of rent as they used to. So this has hit sort of global property prices. And also more recently with the rise in interest rates, that's obviously made debt with owning property much more expensive, which has reduced the income you can get on property funds. And at the same time, global equities have done quite well, particularly technology stocks. The technology stocks have dragged the global equity market up, and we've seen some huge returns in recent years. So should you be holding property in your investment portfolio? Well, I think if you want to diversify and you want to reduce the volatility of your portfolio, then perhaps an OEIC or an open-ended property fund could be good for you, as long as you're focusing on the long term and you're prepared that there could be periods where you can't access your money in these property funds because they may suspend. But if you believe in the underlying assets that the fund is holding, then over the long term, you may still hope for some good growth and income. But if you are worried about liquidity and you still want to hold property in your portfolio, then a REIT or a closed-ended fund is probably going to be better. But just be prepared that this probably won't give you much diversification on the volatility front. But before you do anything and jump into investing in property, it's worth having a look at what your exposure to property is already. Now clearly, if you're already a buy-to-let landlord, you've got physical property, you're quite overly exposed to property, so you probably are not going to want to add much more to your overall portfolio. But if you don't own physical property, but you do own a global equity fund, then it's likely that that global equity fund will include some exposure to companies operating in the property sector. And for example, a traditional global equity fund will have around a 2.5% exposure to companies working in the property sector. So you have already got an exposure to property within a normal global equity fund. And that's not the end of the story. Even traditional businesses that don't work in the property sector may still be exposed to property, and it may form part of their overall income. Take restaurant chain McDonald's, for example. You might think it makes all of its money from selling burgers and chips. But actually, McDonald's has a huge property portfolio. It owns around 40% of the land and around 70% of the properties that it uses. And because it operates a franchise model, it collects rent from all of the different franchisees. And there's around 36,000 locations for McDonald's around the globe. So actually the bulk of its income comes from the rent from properties. So even though you're investing in McDonald's, it won't be classed as a property fund or a property company, but you are still massively exposed to property by owning that business. So when making any decision about any investment, remember you need to focus on the long term. You need to have your financial plan sorted first. What are your goals? What do you want your investment portfolio to do? It's only then can you decide what type of assets you pick in your investment portfolio. I hope you found this video useful. Please don't forget to subscribe so you will get notified of more videos coming soon.